Hi guys, it's Chad Larson with MLD Wealth, and this is March's MLD Money Matters, your go-to podcast for all things finance, where we break down complex market trends into manageable insights. Today, we're going to dive into some of the factors shaping the global markets this year, and it's been a ride, and we've got a lot to cover. I'm going to try my best not to use jargon. I got some feedback yesterday from a great client. He says he used too much jargon, but he's a doctor, and when he speaks to me about, I don't know, what did he call me yesterday? Something myopically, something. Basically, he called me old man eyes. But so we all use our jargon. I'll do my best to not to use it, but here we go. But a lot of things from economic indicators to geopolitical events and beyond. So I'll dive into it as best I can. First off, the global market's performance is under a microscope right now, influenced by a myriad of key factors. Indicators like GDP growth, inflation rates, and employment numbers are at the forefront, painting a picture of market sentiment. These aren't just numbers, they're the pulse of the economy, signaling the health and direction of global markets. But it's not just about those numbers. Geopolitical events have been turning heads and stirring markets. Trade tensions, political instability across the globe are playing their part in shaping market performance. And it's a reminder that markets do not operate in a vacuum, and they are influenced by the world stage. Let's also not forget the role of investor sentiment. Interest rates, corporate earnings reports, these elements are crucial, driving the ups and downs of the market with their dynamic interplay. It's a complex dance, and understanding that these factors give investors an edge. Many times before, I've made analogies in and around, a song or a concert. There's the undertones of the economy. There's the noise of the quarterly results of a company, and the day-to-day, the stochastic, the fear and the greed that drives the market, headlines, sentiment, big, exciting events causing markets to flip-flop, sometimes intraday. But I want to dive a little deeper into some of the geopolitics, turning our gaze to these geopolitics. The ongoing situations in Ukraine, Russia, Israel, Palestine continue to cast long shadows on the market. Continued and increasingly unrest in the Middle East has had its ripple effects, with oil prices experiencing volatility. Disruptions in shipping routes and uncertainties around securing energy supply have led oil to hover around $80 a barrel, up about 12% in 2024. If you remember, 2022 was the year that energy did all the heavy lifting in portfolios. And those conviction positions that were maintained through 2023. Now, we did flex that ownership. We were very much overweight energy. We brought that exposure down, but any exposure in 2023 had middling results. It was truly only technology that drove the bus last year. But oil looks great today. I've said many a times, it's very hard to abandon the fundamental thesis and the value proposition of owning commodity stocks right now, given the macro backdrop and the strength in the balance sheets that they have. But at a commodities level, some of the concerns over a decreased demand picture in the short term, China's recovery being tepid and weak and not really yet going, can cause some concerns. But listen, as thus far this year, the increase in oil is partly due to OPEC's decision to cut daily oil production by about 2%, putting pressure on oil prices. While this might be good news for the energy sector, the long-term sustainability of oil prices remains in question. However, the oil demand on the rise, even considering China's current economic slowdown, we could see further increases in oil prices once the demand side of the equation corrects. Balance sheets remain incredibly intact. Dividends are looking solid. We're seeing lots of shareholder buybacks, so that conviction trade remains, a part of core portfolios. With the U.S. elections on the horizon, I will do my absolute best to keep my politics out of this podcast. Very polarizing issue. But like with all things, the political landscape is under scrutiny, with challenges identified for both the front runners. It's a critical time, and the outcomes here could have wide-ranging implications for the markets. Some things we're watching. In the equity markets, we've seen strong performance, albeit with a note of caution. The tech sector in particular has been driving returns, with the S&P up already 8% year to date. This tech rally, fueled by AI and adjacent companies, highlights the sector's growing influence. A standout example is Supermicro Computer, set to join the S&P 500 after its stock soared 20-fold in 2 years, boasting a market cap of over 50 billion and a 200% increase in 2024 alone. Supermicro, specializing in servers and AI infrastructures, exemplifies the AI trade's impact, replacing traditional companies like Whirlpool in major indices. We have a high concentration of a few companies dragging the markets higher. Sometimes feels like kicking and screaming. This shift underscores the opportunity in select market pockets, especially as we look to balance portfolios with recently neglected value-based names, which tend to be more defensive. Exploring the S&P 500, we spend a lot of time, albeit we're domiciled in Canada. 52% of global GDP activity happens just south of our border. And if we're not talking about that, we're missing really the true proxy and picture of what's going on in the world. To discuss a topic that generates a lot of curiosity among investors, the difference between something we've been talking about, market weight S&P and equal weight S&P. The traditional S&P 500 index is market capitalization weighted, meaning companies with larger market caps have bigger impact on the index's performance. This can lead to a scenario where a handful of high-performing tech giants can significantly influence the index's overall direction. Most recently, we've been alluding to this in the last number of podcasts. Across core models, as of this week and last week, we have completely sold our beta or market weight exposure to the S&P 500 and replaced it with equal weight exposure, taking a breather away from having such a high concentration in technology names. I spoke with a great client who's domiciled offshore, who was fortunate to own a lot of NVIDIA stock, and the conversation was as such as there was a pragmatic, disciplined, prudent reason to reduce the size of the position a year ago and even a year prior to that. And we all would have been wrong. But at what point does growth become, and what point does valuation, growth at what price? If the stock was $1 billion a share and it's the best company in the world, if it's trading at some infinite metric of growth, at some point you're paying too much for something. So reducing our exposure, going into some seasonal weakness here, we wanted to kind of pare back that kind of tech tilted exposure that's benefited us in this front part of the year and through last year, but just to be cautious. On the other hand, back to what the equal weight of the S&P treats each company equally, regardless of its market cap. This approach offers a different perspective, giving more weight to smaller companies and potentially reducing the risk associated with the dominance of large tech firms. For investors, this means equal weight index could provide broader exposure across sectors and a more balanced view of the market's health. Last year, outside of tech, 9 of 11 GIC sectors were negative. And yet the S&P index was up 30%. It was just a few constituents dragging the whole market higher. Each approach has its merits. Market weight indices might capture the momentum of leading companies, while equal weight indices could offer a more diversified risk profile. Understanding these nuances is key to tailoring investment strategies that align with your future financial goals and risk tolerances. I want to tease about something I've been working on for a number of months. I announced a few podcasts ago we had employed the first of its kind in Canada, an independent partnership with a leading institution that provides us ongoing risk and data analytics, an additional layer, additional check and balance that oversees all of our portfolio construction. It's that separation of church and state. I'm paid to have a view. I'm paid to navigate the capital markets and position capital as best that appropriately as we feel to pair to clients' risk tolerances, needs for liquidity, and return expectations. There's a lot we can control. There's more that we can't. Now, one of those things, investing into our people, our process, that aligns with our philosophy is what we call the 3 Ps, avoiding the kind of nuanced volley of products, price, and performance. We really anchor in people, process, and philosophy. So what I'm teasing to, so it's a bit of thrilling news for me. I've been eagerly waiting to share with all of you. After months of meticulous planning and rigorous approvals, we are on the brink and have finally received final approval to launch a bespoke private alternatives portfolio. As many of you know, alternative investing and private credit and private equity have been a area not of focus but of complementary nature that has really set us apart and really positioned us as market leaders in portfolio construction and the reduction of volatility and the increased gross returns that our clients have benefited from. The challenge with these, as much as we have some of the robust, deep relationships across North America and globally to access third parties, the cumbersome nature, the structure, the minimum investment hurdles continue to be a barrier for retail investors. Now, clients have had the benefit to, reputationally and by scale, the leverage of the size of our practice of MLD to benefit to get in a lot of these doors. And we wanted to more formalize that, both from scalability of tax, scalability of deployment, but this, after these months, this innovation is set to revolutionize access to some of the world's most exclusive capital managers, offering our clients, I think, the most cost-effective gateway to unparalleled investment opportunities. And I'm so excited. A little closer to that, I'm going to have a number of key speakers join us from the likes of firms like KKR, Carlyle, Blackstone, Morgan Stanley, etc., on the podcast to be able to discuss our access and our pipes, so to speak, and to be direct participants in some of their most exclusive portfolios. This inclusion of alternatives has always been a cornerstone of our results and volatility management strategies. And as we get near the unveiling of this game changer in May, and to kick things off, like I said, I'm going to have a number of guests to dive deep into the investment thesis behind this exciting venture. It's an opportunity you won't want to miss as we open these doors to even more sophisticated and tailored investment solutions. Not lastly, I kind of want to riff at the end a little bit here. I want to discuss interest rates a little bit. The market, this tech boom early to start the year was kind of the fuse to start the market where we would see the Fed become more accommodating. For years ad nauseum, we've been saying the quotes, never fight the Fed, the Fed driving money supply and the steepening of the yield curve and raising interest rates. All of these things are being negative into the economic cycle. At the precipice, the Fed has signaled they're done their hiking cycle. And now the market gets to lay their bets. How many cuts are we going to see? How deep and how fast will they reduce interest rates, which is very positive for the market. Increased access and easier capital, cheaper capital generally falls in line with more hiring, more reinvestment, more growth into underlying businesses. And it's the start of that bull market. We have to be cautious. If they do it too much or too fast, you can see inflation flare up again a little bit. But the market, by January was pricing in 6 cuts. That's maybe a little aggressive and over their skis a little bit. We're starting to see, as job numbers kind of temper out, the resilience in the housing market thus far, more so into the US than in Canada. Those predictions at the start of the year foresaw about a 1.5% decline in interest rates, which has now been walked back a little bit, has been adjusted. Consensus is about a 0.8% drop. And yes, lower interest rates typically boost equity performance by making borrowing cheaper and encouraging business growth. But I think the market got a little ahead of itself. So I don't think we're going to see a surprise to the upside here. So we're being cautious. But yet the future of interest rates is still in the balance, with major central banks, like I said, caught in a tug of war, whether to lower rates and by how much. So we're watching this closely, and it's undoubtedly going to influence investment strategies going forward. This wraps up kind of that opening segment. I want to ask everyone to stay tuned as we delve deeper into some of these topics and experts guests that we're going to roll out over the next coming months. I really appreciate you tuning in. I get a lot of positive feedback. It's a great way to get, I don't want to say the generic talking points of what we're seeing in the world, but a lot of the feedback that I've gotten from private clients is that it's a great way to get a short, unadulterated armchair view of what we're seeing, why we're doing things, where we see opportunities. I don't want to rehash the same narrative. I think more so I get sick of saying it. Look for some of that feedback as well. I'm not going to readdress every single point made on every single last podcast. We've talked about copper, we've talked about gold, where that fits into a portfolio. Still, there's been no changes to that positioning. So, at risk of just repeating myself, things staying pretty status quo. The major change that was happened, as I said, was reducing our market cap weighted exposure into the U.S. Stock market and to take a more sector balanced approach. As always, feel free to reach out to myself or any member of MLD. It's an incredible team of professionals here, working tirelessly to provide the best service and the best results possible for our clients. I think the last time, this was pre-Super Bowl, I laid my bet down. I took the Niners, so 0 for 3 Super Bowls I've called right. It's a good thing I have a better track record in the public stock market. Guys, thanks so much. As always, we appreciate the trust and confidence. I look forward to hearing from you and speaking and seeing many of you over the next coming weeks, and all the best to you, and look forward to chatting next week.